Hi everyone, hopefully you're having a good day. My name's Andy. The channel's Finding Value. Today we're going to go through Twitter or X to see what people are sharing on social media. I'm going to interject my financial opinions. It's going to be most likely related to three different topics: wealth building, financial topics, and or commodities. So let's dive in there. Let's get right to it. If you want to follow me at Finance, and if you want to join our community, finding-value.com, we do have a discount going on called LEAP, L-E-A-P. It is leap year, and it will be leap day tomorrow or today because I'm releasing this on the 29th. So happy leap day, anyone who's watching. We're going to start with Patrick Karam. He says, "Don't shoot the messenger." This is the NASDAQ daily here. Yeah, these things kind of blow up. So let me shrink this down just a little bit and get you guys centered up here. So looking at this, we've got a higher high coming in the NASDAQ daily. Coming on down, we've got another higher high over here. And this is over, I don't know, about a 2-year period or so is the x-axis. You can see a lower high here. This is the percent stocks above the 200-day SMA. So as this declines, and even though we've got a divergence in the NASDAQ daily going up, it eventually ends with the NASDAQ daily going down when you look at the breadth of the move. So we're losing the breadth of the move. It's starting to roll over. And most likely the NASDAQ will probably roll over. And I agree with this analysis. I've just kind of been sitting here watching it. Don't want to say, my opinion is I think at some point we're going to have to roll over. And when that occurs, I do think it will change money flows to some degree. And I think it will flow towards the things that are actually in a shortage, which is going to be a lot of these commodities coming up over the next few years. Scrolling down, we've got CANAlaska intersects 16.8 meters of 13.75% U3O8 unconformity uranium at Pike Zone on West MacArthur joint venture. And that is a very good strike there with a very high grade. A lot of the times these companies strike this and they do run for a little while. This might run for the next 6 months or something. That's kind of what we saw with some of these other companies that have hit stuff. So this is probably going to run up and people are going to be excited about it. Here's Nat Gas monthly chart. 1 day away from making bottom tail. Cycle starts every 4 years. In previous cycles, natural gas has rallied on an average of 80% in a coming few months. That would put it between 260 and 295 range. Another 40 to 50% upside from here is what his estimate is. And this is the move from the bottom up to about here. So 72%, 80%, 88% from bottom to peak, and then he's projecting a potential 84% move potentially coming. I'm playing it more for the longer term. I think eventually we're not going to be riding the cost curve like we have been in 2011 onward. We've basically been bouncing off the cost curve here. And the cycle here has been reducing natural gas and then expanding natural gas, reducing natural gas as the cycle goes through. We overproduced and now we're going to underproduce, but there's a wall of LNG terminals coming at us late 2024. We have a lot of takeaway capacity. This is going to get real interesting to see how this all, I guess, interacts with each other. When that wall comes online, can't just flip a switch and get a gigantic amount more of natural gas. This is going to be a weird little transition, perhaps. And I'm going to be on the natural gas side, thinking that it's going to go higher from prices down here. The declining U.S. oil production is showing up from numerous views. So the EIA weekly oil report, the U.S. crude production plus adjustment factor plus transfers the 8-week average, is showing a significant decline from last year's peak. So here's last year's peak up on the right here, and then this decline coming down. So is this a sustainable decline? Is it going to continue lower? Or if prices go up, are we going to continue on up? Don't know. But right now, we are a little bit lower. We're even lower than our peak in 2020 here. Looks interesting. U.S. wind generation failed to rise for the first time in over a decade in 2023. So you can see that we actually went lower here in our utility scale net generation. That is crazy that we've actually gone lower in wind. I thought this was the future, guys. How are we going lower in wind if this is our future? Firing up those natural gas plants, I guess. Coming down, Gary Savage. I'm gonna read through this because he is right. He says, before any huge trending move, there has to be a scary counter trend move that gets everyone on the wrong side of the boat. In 98, it was the 22% crash into the 4-year cycle low that set the stage for the bubble that would follow in stocks, especially tech stocks. In early 07, it was a collapse. 36% collapsed in oil that ignited the gigantic rally to $147. In 2020, Bitcoin crashed 69% before turning and running to almost $70,000 in just a year and a half. Miners haven't exactly crashed, but they have frustrated the hell out of the investors for 3 years, and in the process shed over 50% and produced valuations only seen one other time at the bear market bottom in 2015. We are getting everyone on the wrong side of the boat, which is exactly what is needed to power the next leg of the bull market that will produce a piece of cake, $100 silver, and a piece of cake, $5,000 to $10,000 gold. So we got to get everybody on the wrong side of the boat. We get this scare. And what that scare is, it's a selling pressure move in the opposite direction. Gets everybody on the wrong side. Maybe people start shorting it, and then they squeeze to the upside. That is, by definition, a slingshot cheetah that I would always talk about. We would yank it down. It's like pulling back a slingshot before releasing it. So hopefully we get that. If we get that and it's obvious, I think it'll be easy to position in. If we don't get it and it kind of just starts ripping to the upside, I'm in it to some degree. Yep. And I'll capture the move. But if we get the slingshot and there's a bunch of fear, that's an easy one to buy up. An easy one if we get that fear in the market. Risk environment today is more favorable than 2021. Similar amount of money being thrown into the system, my man. Everyone is way richer now than in 2021. In 2021, people thought the Fed would get inflation to 2%. Now everyone knows they are a joke and controlled by Yellen. So this is the percentage of gross domestic product. You can see that our deficit spending is going way faster than gross domestic product. So the total deficit here, and this is the federal debt held by the public. Look at that thing go up. Wow. So that's what we've got, a lot of fiscal spending or deficit spending. Then we go over here. This is the nominal, not real, nominal total net worth households and nonprofit organizations. And you can see us going up. We had a little bit of a dip, but it's come back up. This probably looks very similar to the S&P 500 and or NASDAQ, or a combination of those two. Hopefully it doesn't come back down. That would be no bueno. No bueno. And they're probably going to pump the system. You know, another thing to keep in mind, guys, tax revenues are generated off this. If they lose the market to the downside, they are not going to get those tax revenues. So maybe they're pumping the stock market to get more tax revenues out of this thing. And of course, they don't want the money to rotate in commodities because then it's going to show up in the consumer price index. They need everyone pinned over in the S&P 500 and NASDAQ, because a bubble over there doesn't show up in consumer price index, and they can still tax it. So they're trying to get people to come over here and put all their money in crypto and all these other things that it's not going to impact the consumer price index at all. Warren Buffett on artificial intelligence. So this is what his opinion is. He says, what you really should have done in 1905 or so, when you saw what was going to happen with the auto, is you should have gone short horses. There were 20 million horses in 1900, and there's about 4 million now. So it's easy to figure out the losers. The loser is the horse, but the winner is the auto overall. 2,000 companies or car makers just about failed. So what he says, it's easier to identify the losers, which is the horse in that scenario, versus trying to pick the few winners over the long term. Coming down, inflation is following the exact blueprint of the 1970s. Analysts are wrong about what is coming next. So this is his thread. He's got the fractal of today overlaid with the previous fractal. That's from 2013 to the present of where we are today. What he says, in the past 5 years, USD purchasing power has dropped 20%. Home prices surged from 250K to 400K. The economy witnessed a massive inflation wave. Although inflation has eased recently, it tends to resurface in waves, like in the 1970s, posing a threat to the economy if another surge occurs. And one thing I want to say that is different, each time this thing pulled back was from a housing market overbuild situation. This here is not from a housing market overbuild situation. So there is differences in these areas. Another thing that really got this going in the 1970s here is we had large credit expansion and we had peak oil in the United States only for the lower 48 there. We hit peak oil, it started to decline, and we had oil spiking at this time. We also had oil spike during this move here, but we could grow the world's oil capacity and ship things around quite easily. I think what is coming is another squeeze in oil, which will, I think, really start to push to the upside the inflation. So I think I'm looking for all of the same type of conditions in all of these different areas to see if it's going to be replicated. I think it's going to be replicated, and I think oil is going to squeeze up this year or next, somewhere in that time frame. You can stop the squeeze. What you do is you force everything into a recession. That could hurt demand, but we are starting to lose our stranglehold on the demand of oil. We've got the S curves over in India and China, where a lot of growth in demand is occurring. And as that growth gets larger and larger, we as America is going to have less of an impact when our demand goes down a little bit, even if it goes down in a recession. Inflation can result from supply shortages or excess demand. Lockdowns in 2020 caused supply-driven inflation, while economic stimulus in 21-22 fueled demand-driven inflation. Well, 2020, that was not just supply-driven, it was all that money that was created, it was credit-driven. And then when you create that much credit, it puts everything into a shortage. So I don't think we really had a supply-driven inflation. I think that was pretty minimal. I think it was the credit that really put us over the top. A 40% increase in credit is going to put everything into a shortage. So the fiscal stimulus that he's showing here is putting us into a little bit of a credit-fueled inflation. But these are the same thing, supply or credit or the combination of those two things. It's the same outcome. The pandemic lockdowns and stimulus led to substantial household savings in 2020. By mid-2021, excess savings reached around 10% of GDP, driving demand in 2021-2022. Yeah, so first you save in a slowdown, then you spend the savings. And that spending of the savings is what's fueling this inflation. We've seen that a lot in previous cycles. We have a lot of uh, bank credit, we'll say. There's a lot of money in the system here. We can spend way down and keep this inflation going for, I think, a good while. Household savings accumulated during the pandemic have been fully depleted. No, they haven't. Now leaving people with fewer savings than even 4 years ago. This suggests a continued decline in inflation. He's not right here. This is excess savings, not total savings that someone has. So what they did is they saved money here. So I'll just make an example here so it makes sense. If I have $100,000 in an account and I'm saving more money, that means that I'm saving 105, 110, 100 something thousand at the top. Let's say it's 150. Now I'm saving less money. I'm not saving 10% of my household's excess savings. I'm saving less of it, but my account in my savings is still going up. So if I get over here, maybe I'm at like 150,000 when I was at 100,000 here. And let's say the peak up here was like 110, 115, 120, 125. You're adding it all up. And now you're spending into your savings. So it doesn't mean that it's all gone. It means that you've got a big stack of savings in your account. And now you're spending a little bit more than what you are every single month and drawing into your savings. So it's not that you spent your entire account. It just means that you're not saving any money. You're actually drawing from the account. So this is like a surplus and a deficit, is the way that I view this. He has it backwards. It's not that they're fully depleted. That is not the right. That's wrong. Despite expectations, a key indicator suggests a different outcome. The blue line in the chart reflects fluctuating business costs. Higher indicating rising expenses like 2021, whereas a downward trend implies reduced business costs. Year over year inflation, I don't know if that's right either. Maybe higher cost of business, lower cost of business, but this is year over year inflation. That just means that you're inflating still. You're just not inflating at the same rate of growth. You're still inflating though. So I'm not sure what the ISM service price is. If this is like an index, I'm sure it's measuring the rate of change. He's probably got that wrong too. The blue line serves as a robust leading indicator for inflation. Its ascent in 2021 preceded the inflation surge. And it also forecasted the inflation decline in 2022. Now in 2024, it hints at an incoming inflation uptick. I agree with that. This makes sense as rising business costs often lead to price hikes that fuel inflation. Currently, businesses face increased costs due to rising wage demands from employees. Worker compensation hikes are surging, reaching one of the most elevated levels since 1998. This trend suggests an acceleration in wages, which is an inflationary pressure. Makes sense. Businesses are hesitant to reduce worker compensation. The high number of job openings, currently at 9 million, gives workers significant bargaining power. This allows them to demand for higher salaries due to the scarcity of available talent. Okay? And then we've got more and more and more. I'm not going to go through all those, but I went through, I think, the majority of the important ones that I thought were important. So coming on down. Refinery throughput remains surprisingly weak. So we're at like 80 something percent here, 82, 81 for refinery utilization. Pretty low. We've got coal-fired generation share fell from 42% to 16% since 2011. So we're seeing in America, U.S. coal-fired generation is really coming down. It was over 40%, now it's 16. The one who has basically stolen all that market share is natural gas. Need to see this accelerate downward or else demand is just not that great, is what he says. Product storage, gasoline, distillate, and jet fuel is just continuing to go lower. I think he's kind of joking with that. But 2024, we are continuing to draw down on product inventory. And we are at 2022 and slightly above 2023 inventory levels of that. West Canadian Select back to year-to-date high. This is Canadian Crude Index working its way up. It's at 63.02, and it looks like we're ready to break out to the upside. Fingers crossed, because I do like my expensive Canadian oil. Here's freight futures. Dry bulk was up 8% for Capesize. Panamax was up 3%. Tankers VLCC rates were up 3%, and Suezmax was up 2%. Very nice for dry bulk and for tanker rates. Jorge says total U.S. inventories are lower than in 2023 and 2022. This is oil inventories, not refined products. They are not increasing at the rate of 2023. Inventories should be near the winter peak, and we continue to draw down. This is getting kind of interesting here, guys. I know oil is cheap, 80-ish dollars a barrel or so, but we continue to draw down inventory, and the SPR, I mean, it's not full by any means. It's pretty low. So we'll see if this continues to head lower. We are in the middle of the fastest housing crash in recorded history. He's obviously laughing at it because it continues to go up for the U.S. house price index. Huge crash there, buddy. I know people are talking about we are in the middle of the fastest housing crash in recorded history, even though the price continues to go up. Here's another Gary one. So he says Bitcoin isn't stealing liquidity from gold. Liquidity has been flowing into stocks. Bitcoin is a big player in the overall market, has no inflationary component like precious metals and the commodity markets. I agree with that. The government needs to keep the liquidity flowing into stocks and out of commodities in order to keep inflation in check. Just raising interest rates won't do it. It's not that Bitcoin is stealing liquidity, it's stocks that are stealing liquidity with the help of the cartel trying to prevent the liquidity from getting into commodities. And especially the precious metals market, which is the canary in the coal mine. No matter how hard they try, they will not be able to short circuit nature. Eventually, the liquidity will flow into undervalued commodities and out of overvalued stocks. In fact, the process already began at the bottom in April of 2020 when the commodity bear market came to an end. We're now just waiting for the next leg of the commodity bull to start getting some momentum. Totally agree with this post. And that's exactly what the Federal Reserve needs to do is they need to keep all of the money over in the tech stocks and Bitcoin because it doesn't show up in the consumer price index. He's exactly right here. And that's exactly my thoughts completely with what's going on in the current situation. We're just waiting for that to basically stop going up. And then we're going to see that money rotate back over. And then the Federal Reserve is going to have some problems on their hands because they're going to have inflation. And it's going to show up in the consumer price index. So Happy Hawaiian, he says, not an attack on this guy in particular, as I hear this often. But every time I hear do the work in regards to Bitcoin, it makes me never want to buy it. The implication is that there's only one conclusion from researching it. Disagree, then you haven't done the work. That's what everyone says in Bitcoin. Oh, just research the white papers. You haven't done the work. Okay, good luck with that. Brady says, so this is wheat. Wheat has a 45-year parabolic base and is now backtested plus bounced. Gold is telling us that the second inflationary wave is coming. So is this chart here. And when Fed goes QE infinity, this chart goes ballistic. The commodities bull market is a lifetime opportunity and also a threat to people's living standards and lifestyles. You're either in this stuff or you're going to get absolutely steamrolled at some point if this does continue on this parabolic base. Not just wheat, they're all like this. The physical precious or platinum group metals, the gold and silver and oil, all of it. It's all going to go up at a parabolic pace when money is created at a faster pace than the commodities can keep up at. We'll skip that one. And I think that is basically all we've got for today. So that's what I've got. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We still have that discount, LEAP. We've got a 7 a.m. question and answer session on Saturday. I'll see you there. Hopefully, you guys bring your questions and really start to nail it there. I'll answer to the best of my abilities. And that's all I've got. So hopefully you guys are having a good day. We'll catch you later. This is Finding Value.